Did you know that there's an investment option that can offer both security and market growth? Look no further than segregated funds. If you're intrigued by the idea of protecting your capital while enjoying the benefits of market growth, segregated funds might be just for you. My name is Gregory Rozdeba, and I'm the CEO at Dundas Life, a digital life insurance brokerage in Canada. We help thousands of Canadians, like you, to navigate through the maze of options and get the coverage you need, all from the comforts of your own home. If you want to learn more, check out the link in the description for more information. Let's start by understanding what segregated funds are and how they differ from other investment options. A segregated fund, or a seg fund, is essentially a hybrid between a mutual fund and a life insurance plan, and it's exclusively offered by Canadian insurance companies like Manulife. Let's take a closer look at the key features of seg funds. First, they offer creditor protection, ensuring that your savings are protected in case of insolvency or bankruptcy. This protection can provide you with peace of mind, knowing that your hard-earned dollars are secure. Another important feature of segregated funds is the death benefit guarantee. This guarantee provides protection for your beneficiaries, ensuring that they receive a portion of all of your initial investment, regardless of the investment's performance. It also ensures that your beneficiaries receive the higher of the market value or guaranteed principal. Furthermore, multiple payout options are available, allowing policyholders to receive funds in various installments. Note that you should hold on to the segregated funds until the contract matures, which typically takes around 10 to 15 years. This is also known as maturity period. While seg funds offer these benefits, it's important to understand that they come with higher fees compared to mutual funds. These fees are associated with the additional insurance benefit provided by segregated funds. A significant advantage of seg funds is their maturity guarantee, which means that at the end of the contract, you will receive at least 75% to 100% of your initial capital. It's important to hold the fund until maturity, as early withdrawals can result in the loss of guarantees and potential penalties. One of the primary benefits of investing in segregated funds is the peace of mind offered by the maturity and death benefit guarantees. These guarantees protect a significant portion of your initial capital, providing you with financial security. For example, let's consider Sharon, who invests $100,000 in a seg fund contract. If she passes away or the contract matures after 15 years, she is guaranteed at least 75% of the initial invested capital. If the market value is higher than the guaranteed amount, she or her spouse will receive the full market value. And even if the market value is lower, for example after a stock market crash, they will still receive the guaranteed minimum amount. Segregated funds offer a unique advantage through the ability to reset guarantees. This means you can lock in your investment gains and restart the maturity period, enhancing your investment strategy. Let's explore an example to illustrate this point. Consider Robert, who invests $100,000 in a seg fund with a 10-year maturity period. To take advantage of the current value of $120,000, he decides to reset his principal guarantee. In the event of Robert's death, regardless of market fluctuation, his beneficiary would receive $120,000, even if the fund's value at maturity is below $120,000. They will still receive that guaranteed amount. In addition to these benefits, segregated funds offer estate planning advantages. They allow you to bypass probate fees and ensure a faster distribution of funds to your beneficiaries. If you're seeking a cost-effective transfer of your estate, this feature can be highly advantageous. Now let's delve into some of the drawbacks associated with segregated funds. One consideration is the higher management fees compared to similar mutual fund investments, which don't offer any of the same protection. Before making your investment decision, it's important to carefully evaluate these costs against the benefits offered. Furthermore, segregated funds may not be the most suitable option if you require frequent access to your investment or need liquidity during the contract period. It's important to keep in mind this limitation while considering your investment goals. So, is a segregated fund the right choice for you? Segregated funds are suitable for investors with a low risk tolerance who prioritize capital preservation. If you're looking to transfer your estate, cost effectively, or protect your retirement savings from creditors, seg funds may also be beneficial. In conclusion, seg funds offer a unique investment option that combines the advantages of investment growth with insurance protection. While they come with higher fees and limited access to funds, they provide guarantees and benefits not typically found in other investment products. Understanding your risk tolerance and financial goals will help you determine whether a segregated fund is the right choice for you. Thanks for joining us today to learn about segregated funds and how they work. If you found this video helpful, remember to like and subscribe to our channel for more informative content. If you have any questions or need assistance with segregated funds, feel free to reach out to a Dundas Life advisor today. Stay informed and stay financially secure. Until next time.